Hello everyone, this is Rob McDougall with Zhang Financial here with your weekly economic update. Today is Monday, July 27th, 2026. As we previewed last week, hardly any economic activity reported last week, but what little was reported was really good. In fact, the initial jobless claims was just off the charts good. Now, if we look back just 6 months ago, we were running anywhere between 230,000 new claims every week to 250. And it has been coming down, which is so surprising given AI, corporate downsizings, but it just seems to keep getting better. So last week, the expectation consensus was 212,000 new initial claims, came in at 187, just an outstanding number. Then on Friday, we had 3 housing-related data points. Since they don't move the market, either equity or fixed income, we don't usually go through the numbers. Won't bother here, but simply to say all 3 of those were actually all building permits month over month, new home sales, all better than expected. So inflation expectations. Now this is negative. It moved up 2 basis points last week. Not a big deal. That's 2 basis points over a 10-year horizon, 2 basis points annually. However, it is certainly being driven by the Iran war. Oil prices, again, shot up last week, bringing up concerns. We're going to see the Fed funds expectations just a moment. First, we'll hit GDP estimate. That's going to be announced. The first estimate of second quarter GDP is going to be announced this week. But the Atlanta Federal Reserve, they revised their expectation up to 1.7% growth from 1.3% growth. And as you'll see, and this is a bit unusual, the Atlanta Fed is actually, their expectation is lower than consensus. In terms of the Federal Reserve and interest rate policy, this Wednesday, FOMC meeting, they will be making a rate decision. Kevin Warsh, first or second meeting, he's new on the job, obviously, and individuals think at some point he needs to put a stake in the sand that he's independent from the White House and therefore put through a rate increase. That could happen this Wednesday, and the expectations have been rising. So last week when we look at this metric, there was a 16% probability of a rate hike on Wednesday. Expectations have risen to 36%. And here's what's really changed. We look at the December numbers and what the expectations are. Again, I'll just remind you, coming into this year, the consensus expectation was somewhere between 2 and 3 rate cuts. At this point, nobody's talking about cuts. Very few are talking about even no change. It's all rate hikes. So expectations as of this morning, the probability of no hike or no change to Fed funds rate between now and the end of the year, only 8%. 31% probability of one hike. A week ago, that was 42. And here's what increased. 39% odds of 2 hikes. That was 31% the previous week. And the biggest one of this is 22% probability of 3 or more hikes. It was only 9% the week before. So inflation expectations didn't move up much in terms of the 10-year break-even that we share with you every week. But clearly in the Fed funds future, it is being reflected. Investors definitely think inflation is worse than the numbers are showing, and that the Fed will react to that sooner than later. So last thing about last week is that we're in the middle of the earnings season. And in terms of corporate profitability, you could hardly get a better report than we had last week. A week of earnings of S&P 500 companies. So through Friday, 27% of S&P 500 companies have reported earnings for second quarter. 86 have beat their expectations. Now this number is sort of like monopoly money that I'll share with you. The average beat is 39.3%, which needs some explaining. It's 39.3% because Google, Alphabet, is a large percentage of the S&P 500. I think the combined share class is 6-7%. and they had the most massive beat you will see. They were expected to earn less than $3 a share. They earned $9 because they booked a $98 billion gain on their SpaceX holding. But even if we take Alphabet out completely, the average beat by the remainder of the S&P 500 that have reported so far is 12.6%, way above the 3 or 5 or 10 or 20 or 50-year average. So corporate profitability has been really, really good. So based on the numbers from last week, the growth rate for the quarter, S&P 500 earnings is 37.9. Again, that's boosted by the Alphabet $98 billion gain on SpaceX. So last week it was 24.8%, and at the beginning of the earnings cycle, 23.2%. So let's take a look at how markets responded to what little news we had last week. U.S. equities were down, S&P 500 down 60 basis points, 6%. What really got hit were the Mag 7. They were down 5.4%. And last week we talked about the fact that the previous week, the Philadelphia SOX index, semiconductors, semicap equipment, was destroyed and ravaged. Whatever word you want to use, it was down 10% in 1 week. Last week it actually rebounded slightly positive, but the Mag 7 definitely got hit, down 5.4%, and NASDAQ in total, so ex-tech, not good. NASDAQ in total was down 2.1% last week. In terms of international markets, developed ex-US up slightly, 34 basis points. In emerging markets, also up a little bit last week, 0.48%, both solidly positive for the year, and emerging markets up year-to-date 17.27% versus the S&P 500 up about 9%. So emerging markets continue to lead equity returns. Lastly, in terms of returns, fixed income last week, horrible week. I mentioned oil prices shot up and inflation concerns. It really hit the bond market. So last week, the 2-year U.S. Treasury yield up 17 basis points. That is a massive move. And the 10-year also up 14 basis points. So the Bloomberg U.S. Aggregate Bond Index last week down 0.74. But even worse is the Bloomberg U.S. Long Government Bond, about 20-year duration bond portfolio, that was down 1.44%, which is a huge move in fixed income. So let's take a look at the economic data that we will have this week. We'll just start off today. Haven't seen it, but durable goods orders for June expected out. It was expected for June to be a significant increase or improvement over the May, negative 4.5, expected to come in at positive 1.6% month over month. Tomorrow we'll have the housing price index for May. That's expected to improve as well. For the month of April, that was down minus 0.1. It's expected to be up 0.2%. Wednesday, I mentioned, Fed rate decision, which our best guess is there's no change, but 30% plus probability they will hike rates 25 basis points. Thursday is a very packed day. Initial jobless claims, as always, expected to be a little higher than last week, but last week was incredibly low. But GDP growth for the second quarter, the expectation is, consensus is 2.3%. For the first quarter, final number was a positive 2.1% growth. We'll have personal income, personal spending. Both of those are expected to be down from their May levels, but still very solid. Personal income is expected to be up 0.3% month over month. Personal spending up 0.4% month over month. And the key inflation gauge, PCE, personal consumption expenditure, this is the one the Federal Reserve targets, for the month of June is expected to be up only 0.1%. For May, that was up 0.3%, so that would be a very welcome sign. Lastly, Michigan consumer sentiment number, the final number hardly matters, but it was 54.4 for July, significantly higher than what we saw in June. So that's it for our economic wrap up. We thank you so much for attending. Look forward to seeing you next week. Thank you.